Hello and welcome to Let's Invest Right. Happy New Year, everyone, from Let's Invest Right. Guys, I would like to wish you all a very successful year 2021. And in this video, we have selected 5 stocks which are going to be part of our portfolio throughout 2021. Now, I would like to give you a brief introduction about this video. Now, we have selected some stocks based on our research, based on its performance in 2020. We have seen growth potential in those stocks. They are from different industries. Some are oil industry based stocks, some are from solar companies, solar industry, and so on. So we will be discussing in detail very quickly about these stocks. Now, you need to do your due diligence. You need to really research on these stocks. However, if you are a day trader, we would not recommend you to buy these stocks. And it requires a lot of patience to make money from stocks especially.
Hello everyone, I am Hassan Ayub and welcome to Let's Invest Right. 2020 has been a different year. It has changed the way we live. It has changed the way we worked. Many things have changed, and we should be thankful to some of the companies in the tech sector like Amazon, like Netflix. Well, they provided us the entertainment. Amazon provided us the opportunity to shop online. Netflix provided us the opportunity to stream different videos. If imagine these were not there, what we would have been doing. Companies like Shopify has been some of the stocks that have grown rapidly. Imagine if Shopify was not there, what small business would have been doing. It has provided them the platform to have their online presence, to have their online store, and people are buying from this. So it's a great achievement. And during the COVID, many tech companies have come up with new ways, like Zoom. It's one of the companies that has performed really well. From nowhere, many businesses have shifted to Zoom. Now meetings are being held on Zoom, and I think this is the way forward. Even in the future, it would continue. Many businesses would continue to have their online meetings on Zoom. It's a great software, great achievement. 2020 on one side has been marked as a year with crisis, with challenges, with COVID, with lockdown. On the other hand, we need to look what we have done, what we have achieved. In 2020, there were many opportunities that were identified due to lockdown, and companies like Zoom have provided them the answer. Well, it's been a tremendous year for many companies, but on the other hand, many sectors are still struggling, facing many challenges of their revenues, challenging of their businesses and their cash flows. Some companies in the pharmaceutical, like Pfizer, have found the vaccines which is tested successfully, and now it's been exported across the globe. So it's a great sign before we move into 2021. Although some countries like UK are still thinking of their lockdowns, and so there's still some question marks, and we have to keep our fingers crossed and continue praying that COVID-19 does not impact us in 2021. As we are approaching 2021, we have identified 5 stocks that have great potential of growth in the next year, and that could give you great returns on investments. We'll discuss about the companies, their products, services, some watch outs that we need to have a look, and why we expect these companies to grow. So let's start.
Guys, so the first company which we have selected in our portfolio again is part of EV industry, which is our really personal favorite stocks. Whether we talk about Tesla, we talk about NIO, we talk about XPeng, or all the companies which are providing electric vehicles. Imagine if there is an EV boom, or we expect electric vehicles to take significant shares across the world. In that case, suppose we are having right now the petrol vehicles or diesel vehicles. So with the petrol vehicles or any type of fuel vehicle, it's very important to have gas stations. In the same way, it's very important when we believe that electric vehicles are going to be everywhere and they are going to be the next era for automobile industry. Many companies like GM, even technology companies like Apple are taking interest in coming to this field and being part of manufacture of electric vehicles. So in that case, it's very important to understand that companies which are providing charging solutions, fast charging solutions for electric vehicles, they would also grow along with electric vehicle manufacturers. In our previous videos, we have also discussed about ChargePoint, which currently is not trading in the market, but its SPAC is trading with the name of SBE, and soon they will be having merger, and we have recommended that stock as well. But in this video, we have selected a company which is a competitor of ChargePoint, which is a listed company whose name is BLNK. Yes, and its ticker symbol is BLNK. Now, it is very important to understand, like ChargePoint, the company BLNK is also providing commercial and residential ChargePoint solutions. They are providing solutions which are easy in terms of payments, in terms of tracking all across the country where these charge points are available, where their charge points are available, and it's very easy for the clients to locate, to pay, and to use these services. Now, one of the most important part to understand is recently we have seen some news regarding BLNK, which attracted us towards purchasing of this stock, this company's stock. One of the news was this company is currently doing a lot of agreements with companies, and recently Apple have also included it in its EV routing map, where they are providing charge point locations in their map. Also, this company is having different agreements, as you can see on your screen, some of the news about the companies. And so now let's see. This company was also, was also a part of many news channels, many investors' portfolio. However, we have seen some ups and downs over the period of weeks before, in the month of December especially. There were some allegations on its revenues. There were some issues with the company. However, we have seen this company coming back very quickly and again getting to its peak range. Now, don't expect that this would only be growing with the same trend that is upward. We could expect in the month of January correction level, which is very normal. We have seen its growth multiple times in previous month. However, we could see a significant level of correction as well. But that doesn't mean that it accounts for your panic selling mode. Now let's see its growth over the period of year. Let's look into its graphs and let's see how many times the investors have really gained in the period of previous year. So if you could see on your screen, we could see the graph of this company BLNK. It started from $1.87 per share, and currently it's trading at 45.24, meaning it has grown 23 times in 2020. Guys, imagine 23 times in 2020, and we could see potential of this stock to grow. However, keep in mind, in 2021, in this week, especially in the first week of 2021, we could see a significant level of correction. Now, significant means, of course, it has grown over the period of year 23 times. So we could see it retracement and up to 20% or 15%. However, in long term, we should believe that this company would see exponentially growth, and it has a promising number of stations. Now these stations are available in all the locations, major locations in the United States, from say airports to public parks to healthcare facilities. They have been doing a lot of contracts with healthcare institutions, with electric vehicle companies, with companies which are right now in its initial phase. So BLNK itself has a lot of potential to grow, and let's look into its recommendation from analysts. As we could see on our screen, it's still in between buy and hold. recommendation rating, and even in the month of December, it was given one rating from the analyst as a buy stock.
Let's start. So one of the companies that we have in our list is Shell. Shell needs no introduction. Everyone knows about it. It's one of the main players in the oil and gas industry. It's, in terms of revenues, Shell is the fifth largest company across the globe and the highest in European region. Shell is involved in different sectors of oil and gas industry. It's vertically integrated. This means it starts from the exploration and production of the oil and does the refinery, transportation, distribution, and marketing, along with the power generation and trading. The company has renewable energy activities such as wind, biofuels. Moreover, the company is involved in trading of crude oils, heating oil, diesels, fuel, aviation fuel, marine fuel, biofuel, lubricants, and many others. Shell has been operating in more than 70 countries and it employs around 83,000 full-time employees. Looking at the year-to-date graph of stock price of Shell, the starting price was around 60.37 for Shell, and it was going down until it reached 18th of March when the price was significantly impacted due to COVID. But the price started moving up slightly and then started going down again in the month of end of October. However, currently the price is at 34.35. If the price reached to the pre-pandemic level, which was at the start of the year, which is 60.5, you could have a return of 75% approximately, and that's great. Now let's talk about why we think Shell could be a great investment opportunity. The company is investing significantly in becoming the global supplier of clean energy. The company has made significant investments over the past few years. In the month of April, 66% of the dividends were cut by Shell this year. Investors didn't like it. Companies like Chevron, ExxonMobil are highly appreciated for paying dividends. But why the company cut its dividend? Well, dividend is one of the major cash outflows of Shell. It's a significant impact on the cash flow, and managing this cash flow during the crisis, the oil prices was going down significantly and there were production cuts. So managing the cash flows was important for the company, and investing in the right way. If the company is thinking long term, then cutting dividends for once or twice won't make a difference. Although some investors are really investing in companies like Shell, ExxonMobil, for investment for dividend purposes, and that's why many investors didn't like this approach from Shell. Shell plans to become zero carbon emission company by 2050, which would be a great achievement. The company wants to shift from its carbon-based fuels. There's a lot of work to be done, and investors have to be patient about this. They have to keep on waiting because there would be ups and downs with the share price. However, if the approach is right, if the investment is made in the right way, then Shell would be a great potential opportunity. When we talk about the investments for Shell, the company has capital investment budget of $20 billion. Out of this, 12 billion the company is investing in growth and in transition. So this is why I am saying it's a significant investment that the company is making, and will help the company to achieve what it's trying to achieve. Before making investment in the company, there's one watch out that we would like to say. It's a long ride. It could be bumpy ride. It could go up and down, and investors would have to wait because the price could go up. Also, don't remember the main revenue streams for Shell is from its current exploration and production of oil, and if this is impacted, if the oil price is impacted, then it could impact the revenues and profitability of Shell, which could have a say on its share price. So that's one of the watch outs that one needs to consider before making investments. Looking at what analysts are saying, out of the 3 analysts that have recommended Shell, 2 of them are saying it's a strong buy stock, while 1 is saying it's still a buy. And overall rating is around 1.8, so it's between a buy and a strong buy. The price that we are talking about, the lowest analyst price is around 31 in the next 12 months. The current price is around 34.4, while the average analyst expects the price to be around 45.17, and the highest could be 57. And as I said earlier, if it reached to the previous January level, then you could have a return of 75%. To conclude, Shell is one of the leading companies across the globe. In terms of market revenues, it's the 5th largest companies with a market capitalization of 137 billion. It's a good investment, and with growth and the potential and the future that the company is talking about, it would give positive results on your investments. Before revealing the next company, well, in 2020, EV industry was at a boom, and we expect the same trend to continue in the years to come. EV would define the future of automobile industry. One of the companies that we have selected out of the 5 is NIO. Why do we expect NIO and not Tesla? Despite Tesla being the pioneer in this industry. And many new players have entered the market like XPeng, Li Autos, Arrival, and many others. NIO is also called the Tesla of China, and the trend of sales would continue. And we'll discuss why we expect the price of NIO to grow, and it would be a great potential opportunity for investments. Let's first look at the year-to-date chart. 2020 was a great year for NIO. The starting price of the company on January 2nd was 4.10, and currently it's being traded at 48.3. With this, the company has almost reported a growth of 12 times of the investments. If you look at chart here, in the month of November, the price was at its peak around $55, which would have been massive growth. Currently, the trading price is at 48.4. So let's discuss why we expect NIO to be a great potential investment opportunity. Well, the company has been performing well. Over the past few months, the company has been performing better than the expectations of analysts, and the overall share price has been going up, and the trend has continued. The company is expected to launch a new battery of 150 kilowatt per hour, which would increase the mileage to almost 900 kilometers for one charge, which would be a great achievement for the EV industry. The company is planning to launch its first sedan car after successfully launching its SUV, which is you can see in the market. Well, the company has been growing at a rapid pace, and it's expanding and finding new markets. Moreover, the company will announce its second generation battery swap stations, which would be a game changer for the industry. Well, China is the biggest market for EV industry, and the country expects 25% of the cars to be EV. Moreover, globally, we expect 10% of the cars to become EV by 2025, and that would help companies like Tesla, NIO, and even the new entrants like Li Autos, XPeng to have and gain the market share and capitalize on the opportunity that's prevailing in the market. NIO is planning to enter in European markets, which would be a major boost, and so the next year would be very critical for the company. For a growth stock like NIO, we need to look at the top line. The company is expanding and growing its sales, its units, its revenues, in whichever way you see it. Moreover, the company is finding new opportunities and entering into the market. As I said, the company is launching its first sedan car. Moreover, if you look at the overall P&L of the company, the margins are improving, which is a positive sign. So this will help the company in achieving its profitability. The company recently launched additional shares to gain more funds, which is important as the company is expanding, entering new markets, investing more on selling, investing more on research and development. So the company needs cash, and with growth, it will help the company. Well, before making investments in NIO, there are a couple of watch-outs that I would like to tell. If you look at the company, the price of the stock and the sales that we expect, the price to sales ratio is quite high versus the industry average. The price to sales ratio, which is the next 12 months sales that we are talking about, it's around 9.8 versus the industry average of 0.6. So we can say the stock price is a bit higher and overvalued, but being a growth stock, the sales are low and the company is growing at a rapid pace. The deliveries are more than 100% in few of the months if you look at 2020, and we expect the trend to continue as the company enters the new market. The other watch out that I would like to highlight here is the boom in EV industry. Well, this year the EV industry flew up and up, but will the trend continue? That's a question mark. However, if you look at the companies fundamentally, if you look at the products of NIO are amazing, and that's why I expect still the company to do well in the next year. Looking at the recommendation trend for NIO, out of the 8 analysts, 5 analysts are saying to hold the share, 2 are saying to buy, and 1 is saying to hold. Looking at the recommendation trend in the month of December, out of 8, 5 are saying to hold the share, while 2 are saying to buy this share, and 1 analyst is saying it's a strong buy. Overall rating is around 2.3, so it's between buy and hold. If you look at the price, the average price is around 40.59. However, the price is 48.4, and it could reach as high as $60. To conclude our discussion on NIO, the company has been growing at a rapid pace. 2020 is an example of this, from the stock price of 4.1 to around $48. Around 12 times of the investment, it has already given good returns to the investors. And we expect the trend to continue. We expect the EV industry to again boom, and this will help companies like NIO. If there's any company other than Tesla, then it's NIO.
Another company which we are going to discuss, which is part of our portfolio in 2021, is ENPHASE, whose ticker symbol is ENPH. Now, this company belongs from solar industry. We have seen ENPHASE and one of its competitor, SolarEdge, growing tremendously in 2020. Now, why we have selected ENPHASE? Because we have seen this company's growth more than SolarEdge as per our research. Now, I do remember in 2020, back in the month of July or August, the stock of ENPHASE was trading as low as $40. So guys, as you can see on your screen, that this stock started at around $26.37, and its price reached more than $172.93. So it has seen more than 5.56 times of return. Although a couple of months ago, say in the month of July or August, there was a short seller who actually alleged this company on providing some financial data which was fake in their view, and that was the point where this stock was dropped significantly, and it dropped more than 50% over that period of time when this news was shared. However, with the passage of time, the stock has gained again the investors' confidence, and we have seen it growing multiple times from that level of 50. Now it is 150. So within the period of even 6 months, the stock grew more than 3 times. So it's very important to understand if such kind of news is shared by a short seller who is actually taking the short position on these stocks, and what is actually the core business of this company. Since the core business of ENPHASE is very strong, they are into micro inverter technology, providing to home and commercial business owners. And with the formation of the new government, we will also be seeing further growth in this stock as compared to its rival or its competitor SolarEdge, which also has seen a tremendous growth over the period of year. So both of the stocks are our favorite. However, in our 2021 portfolio, we will be including ENPHASE, and we would be expecting it to grow over the period of year. Now, what are the reasons why we are thinking that this stock is going to grow? We have seen in the past few weeks, as soon as when we had this news that Tesla is going to be part of S&P, we have seen it tremendous growth, and it attracted a lot of investors. The same is with ENPHASE. ENPHASE is going to be the part of S&P, and it would be replacing Tiffany and Company very soon. So it would also follow the same trend that was given by Tesla. So further, we are going to see some more growth. Now, second most important part is, as a whole, solar industry companies, whatever are part of solar energy companies or clean energy, we would see them growing over the period of a year, especially after the Biden's government is formed. So guys, it's very important to understand, these are the clean energy companies. They have a lot of potential. So let's invest right, and let's invest in these companies. By one of the research published by GTM Research, they have acknowledged that by previous year, both of the companies, including ENPHASE and SolarEdge, would be accounting the market share of more than 79%, providing solutions, solar solutions to home consumers in the United States. So that means their market share will be increasing in upcoming years as well. And with the microinverter technologies providing especially to the home users across the country, and the government further will be announcing some benefits to people who are using clean energy. So in that terms, we would see this company really growing at a rapid pace. Now, one of the watchouts of this company, ENPHASE, is the valuation really looks overvalued as of now. However, the industry is really promising. So we need to believe in a company which is really growing. We have seen it growing over the period of year previously. So we expect it to grow. Now, even if we go and look on our screen, the analyst rating also says, we could see it in a buy range. It has been given 2.3 ratings. Average price is 132.75 by the analyst. However, currently it is trading in the range of 170s. So it is overpriced as of now. However, even if you we could also expect in upcoming days some correction in solar energy stocks or oil companies stocks as well, since the market really traded at its highest level in the end of the year previously in the month of December. So we could expect some correction very soon.
Last company in our list is Apple. Well, the company needs no introduction. If you look at the fundamental analysis, if you look at any company fundamentally, Apple ticks each and every box. The company is growing. The company has strong portfolio. In fact, if you look at the portfolio of the companies, it has one of the strongest portfolios across. If we talk about dividends, the company pays dividends to its shareholders. If we talk about the growth, the company has been growing. If we talk about debt to equity ratio, the company has an appropriate equity to debt ratio. So overall, the company is strong and it's growing and has a strong potential. And we expect the trend to continue because the company has been investing heavily on innovation, and it has come up with several products that could really be breakthrough for the industry. So let's first look at the year-to-date chart for Apple. Looking at the year-to-date chart for Apple, the starting price for Apple was around $74 and currently it's being traded at 133.7. So the growth is around 80%. If you look at the overall trend, the company was going up while it reached March, where the pandemic impacted the overall share price and the price went down to as low as 53.15. But then the upward trend continued, and if you look at here, the trend continued and the share price started moving up. Also, if you look at here, the company has been paying dividend every quarter. It paid in the month of Feb and then it paid in the month of May. Again, the company paid dividend in the month of July. The boom in the share price continued, and if you look at till the stock split occurred, the share price started going down because with the stock split announcement there was hype for Apple and it was making the price go up. After the stock split there was retracement. Now let's talk about why we expect Apple to grow in 2021. Well, the company has been innovating and coming up with several products. Not only this, the company growth has been increasing. If we talk about the non-iPhone sales, grew almost 30% this year, despite of the supply chain constraints and lockdown globally, which impacted the overall managing the business. So that's a great achievement for the company. The company has also come up with new products like AirPods, HomePods, Apple Watch, MacBooks new series, and all this. The company recently launched iPhone 12, and after the launch, the sales are showing positive results. Moreover, the company is planning to increase its production by almost 30% to manage the supply and demand of iPhone 12. The other reason why we expect the Apple to grow is the subscription-based services revenues. The company has been expanding its services more towards subscription-based. If you talk about Apple TV, if you talk about fitness, the company is entering and finding new opportunities and entering those and trying to capitalize those opportunities. The services revenue are growing almost 16% year over year, and this could reach almost 100 billion in the next 5 years. Apple TV continues to be a new streaming content. Apple Fitness Plus is another achievement that the company has made. With new ways of working, 2021 could be a hybrid model, with some people still working from home and some still going to office. Some students going to school while some learning at home. So this could help companies to grow sales of its Mac and iPad. Moreover, the 5G technology is coming and entering the market, and this would have great enthusiasm and it will help in increasing the sales of the company. Talking about watch out for Apple before making investments, well, there's hardly any. Only some expects that the share price is slightly overvalued. However, again, it's a growth model, growth business, and the company is coming up with new products. So the share price is expected to grow, and with the increased demand and increased services revenue, the company will have more and more revenues, and this will help the company in expanding its space and entering into the new markets. Looking at the recommendation trends of what the analysts are saying, out of 38, 11 are saying it's a strong buy, and 21 are saying it's still buy, and 6 are saying it's a hold stock. So overall, it means that it's still a strong buy, despite many are saying that it's overvalued. Recommendation rating is 2, so this means it's a buy stock. Overall average price is around 128.55. However, the current price is slightly higher than that, 133.7, and it could reach as high as 160 in the next 12 months. So to conclude discussion on Apple, well, the company has been growing at a rapid pace. The company is innovating, coming up with new products, entering into new markets, identifying opportunities and capitalizing it. So with the growth and the changes in the way we live, changes in the way we work, we expect the company to grow in the next year as well, and you could have great returns on your investments.
Thank you very much for watching us, and I hope you have liked this video. And if you haven't subscribed yet, please subscribe to our videos. And these stocks, whatever we have discussed, it's just part of our research, our due diligence, and this is for entertainment purpose only. Howsoever, as we have mentioned, that these are part of our portfolio, and we see them growing in the year 2021. I would like to wish you all once again a very happy new year. Thank you very much for watching us and liking our videos.